Most investors have no idea what's already happening. They haven't even looked beneath the surface during this market meltdown to realize the huge rotation that is taking place. Complete change in the investment landscape based on the arrival of inflation. And this is going to completely change the dynamics that have existed for investors over the last decade. Pretty much everything that worked while the Fed was inflating this bubble is not going to work as the air comes out of it. And the air is going to come out of it. Despite whatever efforts the Fed may pursue to prevent that, I think they've already pricked this bubble, and there's really no way to prevent it from deflating. So first of all, to discuss the topic of inflation, the first part of the stagflation equation, clearly we have a huge inflation problem. And we've had this inflation problem for over a decade. It's just that it hasn't manifested itself in a way that was problematic to the Fed or to investors, because the inflation was resulting in asset prices going up rather than consumer prices. I mean, consumer prices went up, but not by an amount that caused an alarm, especially since the government was able to disguise the true degree to which prices were rising with the CPI, which doesn't really do a good job, I think, by design of accurately reflecting what's happening in prices. It substantially understates the degree to which prices are going up. And so given the ability of the government to pretend that we had inflation below 2%, that gave the Fed cover to continue to create more inflation under the guise of quantitative easing and stimulus and 0% interest rates. But that money flowed primarily into financial assets, but it also fueled a record increase in U.S. trade deficits. In fact, we got news that the December trade deficit was a new record, $101 billion. That is the first month where we've had a trade deficit in excess of $100 billion. This is merchandise trade, goods. And for the entire year, our trade deficit in goods eclipsed $1 trillion. That is an unheard of deficit. Never before has anything that bad been achieved, by any nation. Part of that actually kept a lid on inflation, even though the way the government measures inflation, we had a 7% increase in consumer prices. Imagine how much more consumer prices would have gone up had $1 trillion worth of stuff not been dumped into our market by our trading partners. And how did we pay for all this stuff? We didn't. We printed money, and we exchanged the money we printed for the goods that the rest of the world produced. And Americans didn't even earn a lot of the money that they spent. It was just handed to them by the government in the form of stimulus checks or other bailout money. And where did that come from? Well, it came from the Fed's printing press. We did the worst possible combination of monetary and fiscal policy in 2000 when we first entered, the pandemic, March of 2000, because as the economy was shutting down due to COVID and due to government restrictions as a result of COVID, instead of doing the right thing and contracting money supply along with the economy so demand would go down with supply, the government and the Fed conspired for the worst combination of monetary and fiscal policy probably in the history of the United States. As millions of Americans were leaving work, the government mailed everybody checks to replace their paychecks. But the key is when you're earning a paycheck, you're being productive. You're helping to produce goods and services, and then you're rewarded with pay, and now you can consume some of the goods and services that you help produce. But when you're not working, you need to consume less. But the government didn't want that because that would have meant a more severe recession. So the government sent everybody money to buy goods and services that they weren't producing. And the fact that we have big shortages should not have been a surprise. I mean, it's an obvious consequence of a failure to produce. You don't have stuff and you get a shortage. But we had all this extra demand thanks to the government and the Federal Reserve. And we haven't even really begun to feel all the consequences of that inflation. I think the inflation that we've experienced in 2021, a lot of that was largely the delayed consequence of the inflation that was produced prior to 2020. I don't even think we've caught up to that inflation yet, which is one of the reasons that we're going much higher. Not only wasn't inflation transitory, but it's going to be far higher than it was during that supposed transitory period. And of course, I was one of the few people when the Federal Reserve was claiming that the inflation we were experiencing would be transitory. At the time, I said the Fed was lying about that. I said that inflation was as transitory as the subprime market was contained. That's exactly the lie that the Fed told us in 2007 when the mortgage market blew up, the subprime market. The Fed told us not to worry, that there wasn't going to be a problem, that the damage was contained to this small segment of the mortgage market. It wouldn't affect the overall housing market. It wouldn't affect the economy. And of course, we ended up with the 2008 financial crisis. I think in many respects, people at the Fed might not have even believed those lies, but they told them anyway because they wanted to placate the markets. They didn't want the markets to be afraid of what was going to happen. And I think that was pretty much what they were doing again this time. They didn't want to level with the markets and deliver the bad news about how bad inflation was going to be. So they just pretended it was transitory. Now, maybe they also hope that the problem will go away. In fact, they're still hoping it's going to go away, because if you look at what Powell is talking about doing in order to fight this inflation that it now admits wasn't transitory, is too little too late. How are you going to do something about an inflation problem by throwing gasoline on it? Still a stimulative rate of interest. Yet somehow now it's an aggressive tightening that's going to take care of the worst inflation in 40 years. And the reality is it's not the worst inflation in 40 years. It's the worst inflation ever. Because 40 years ago, when we were measuring inflation, we were using a very different CPI than the one we're using now. So you can't really compare the CPI today to the CPI 40 years ago when they're completely different. So if you measured what happened to prices last year with what happened 40 years ago using the same CPI that was being used then, in 2021, we had an increase in consumer prices of about 15%. And that would make it higher than any year of the 1970s. In fact, it would be higher than 1980, which until last year was the high watermark for the CPI at 13.5%. But how did we put out the inflation fire in 1980? Well, Paul Volcker brought interest rates all the way up to 20%, so that we had a real rate of interest of 6.5%. And we created a powerful incentive to hold on to U.S. dollars and to save money, because we offered savers a very high real yield on their savings. And of course, Treasury bond yields also soared. I think the yields on 30-year bonds got up to something like 14%. And so we were offering a positive yield. Inflation, even if you believe the government's numbers, which I don't, still a negative 6% interest rate. You are not going to encourage savings with negative 6%. You're not going to discourage debt. You're not going to do anything to change the dynamic. You're not going to get out in front of the inflation curve. You're going to fall further and further behind if you continue to stimulate with cheap money. Now, yes, it's not as cheap as it was, but if inflation continues to accelerate, which it likely will, real interest rates will actually be falling, even as the Fed is slightly raising nominal interest rates. So they're actually pursuing a more stimulative policy while pretending to tighten. So they're continuing to make this inflation problem worse. But here is the bigger problem. The only way the Fed was able to justify these artificially low interest rates and quantitative easing was under the pretense that an absence of inflation gave them the leeway to do that. Now that inflation is triple or more, 2%, there is no way the Fed can justify maintaining the artificially low interest rates. Because even if they raise interest rates 2%, they're still artificially low. The only reason that the Fed kept rates so low was because we had such a gigantic debt bubble that those low interest rates were the only thing keeping us afloat. If interest rates were allowed to normalize, we would have a far worse financial crisis than 2008. We would have all the big banks that we bailed out failing. We'd have a crash in the stock market. We have a crash in the real estate market. And not only would the private sector have difficulty servicing its debts if the Fed were to allow interest rates to go to a natural level, but the United States government would also be in the same predicament, maybe even in a worse predicament. The U.S. government would be forced to default on its national debt. So the reality is the Fed is caught between a rock and a hard place. There is no way out. There's only a bad choice and a worse choice. The bad choice is to fight inflation, let interest rates go up, and let everything collapse. The worst choice would be to continue to create inflation to avoid that and postpone the consequences of hyperinflation. But unfortunately, that's likely the choice that they're going to make. And so what do investors need to do based on this new reality? Because even though the Fed is still going to be providing cheap money, it's not going to be cheap enough to sustain the bubble. The air is already coming out of the bubble merely based on the fact that the Fed is talking about tiny rate hikes in the future has already collapsed a lot of the bubble stocks. A lot of these stocks are down 50% or more. They're going to continue to fall. In the meantime, look around the world. As I'm speaking, I think the Nasdaq's down about 14%. S&P was off about 9%. Foreign markets are up, especially if you look at the value stocks. We're seeing huge rallies in dividend-paying stocks in Europe and Asia, stocks that have been left for dead for years, stocks that were used as a source of funds. People are now piling into those stocks as they liquidate these overpriced assets because you can't go to cash right now. In an inflationary environment like the one we're in now, if you want to get out of overpriced U.S. stocks, companies that don't earn money, that trade on a dream, that have high PEs or no E's at all, and they just, trade on hope and prayer, as people are selling these stocks because the momentum is no longer there, they can't go to cash because inflation is going to destroy the value of their cash. They can't go to bonds because they have the same inflation problem with bonds, only worse because they can't get their cash until the bonds mature, and they could take a huge loss on the bonds if they want to sell prior to maturity, as ultimately long-term interest rates go up. So where do you go when you get out of overpriced U.S. stocks? Well, you got to go into underpriced foreign stocks, which basically allows you to accomplish two things. You get out of U.S. stocks and you get into better valued companies that actually make money right now, not potentially in the future, but that make money right now, making things, selling things, generating earnings, and paying dividends. But you also get out of the U.S. dollar because the dollar is going to collapse when people understand that the Fed has no ability to control inflation. And inflation is going to continue to erode away the value of the dollar. What's really going to cause this recession is inflation, because inflation is going to drive the cost of living up so high that Americans are going to be spending a very high percentage of their disposable income on the basic necessities: food, energy, rent, insurance, healthcare. They're not going to have money left over for discretionary spending. And that means the people who earn a living in the part of the economy that benefits from that discretionary spending, they're going to be unemployed. You got to get out of the dollar, and you need to be in inflation hedge investments. One, obviously, being gold and silver. Prices are going to go up dramatically. I think we're going to have another leg similar to the leg we had from 2001 to 2011, where gold was up about 5x. It could easily happen again. Forget about tech stocks. They're old news. They worked in the past. They're not going to work in the future. What's going to work is what worked in the 1970s, the last time we had stagflation. Of course, this time it's going to be far worse. The inflation is going to be much worse. The economy is going to be much weaker. And unfortunately, we won't be able to put a stop to it like we did in 1980 because we have no ability to raise interest rates because the country is completely insolvent, which was not the case in 1980 when we were still a wealthy creditor nation. We still had trade surpluses. We had relatively small debt relative to GDP, the mirror image of America today. So we're not going to have a positive ending. We're going to have something completely different and catastrophic. And so it's even more important that you stagflation proof your portfolio, because it might end up being an inflationary depression, not just a recession, but a depression. And the inflation could end up being hyperinflation. And so you also want to get into foreign equities. I think that should be the bulk of a portfolio, good dividend paying foreign equities. So you need to follow that blueprint.